Hey folks, Chris Versace here from Tematica Research with the week ahead. And it is going to be a very big week for the markets. But before we kind of move into that, let's just recap what happened last week pretty quickly because it was pretty stunning. I mean, the S&P 500 rose 4%. The NASDAQ jumped higher by 6%. Almost, not quite, but almost wiping out the losses that both of those market indicators posted the week before. So as we approach kind of the halfway mark of September, a month known for being rather challenging, the S&P 500, the NASDAQ composite, they're down 0.4% or so. Nothing alarming and far better than we would have thought during the first week. But we have the other half of the month to go. So what's kind of the setup as we move into it? Well, the S&P 500, it's not overbought classically if you look at its relative strength index, but it is looking what they tend to call short-term overbought. We saw this big push, and a lot of technical analysts are looking at certain key levels for the S&P 500, including 5650. At that level, the thinking is we are short-term overbought in the market. From a fundamental perspective, however, when we look at where the market is at that level, it would be trading around 23.3 times. In other words, a hair's breadth away from the multi-year peak PE multiple that the market set earlier this year. Kind of raises some questions as to how much more can the market go. I think a lot of that is predicated on earnings expectations for the second half of the year and for 2025. But here's the thing. The second half of the year, those S&P 500 consensus earnings have been coming down. If we take a look at where they were exiting July, the second half of the year was up about 11% compared to the first half of the year. Now, midway through September, that's down to about 7%. Good number, no question, but still not as robust as we saw earlier. I do think, however, that as we start to move through September, get into October, September quarter earnings season, the market is going to start to look forward towards consensus EPS for the S&P 500 for 2025. And as we sit here now, according to FactSet data, that's up about 15% year over year. And it just seems to be a bit of a disconnect because if you look at that level of growth, it usually means we've got a vibrant economy, not one that is heading for a hard landing. And if you look at the CME FedWatch tool that says the market expects 100 basis points in cuts by the Fed by the end of 2024 and a cumulative amount of about 225 basis points in cuts by mid-2025, it tells you that the market is thinking that there's a hard landing approaching. So that 15% EPS growth, quite a stretch if that is the scenario. Our thinking, of course, is a little more tame, not quite as aggressive. We see probably about 50 basis points between now and the end of the year, including the first 25 basis point cut coming this week from the Fed. And we see probably, another, several cuts coming in 2025, subject to the data that we get. We're not alone in calling out the market being overly aggressive. Fitch and others are kind of joining the parade. So we feel pretty good about that number. And if you take a look at recent economic data for August, it really says that the Fed is likely to deliver that 25 basis point rate cut. But when it issues its economic set of projections, the odds of it saying that there are going to be 3 more rate cuts before the end of this year, and as much as the market is looking for in 2025, I think the market's going to be surprised. And the setup for this is that we're potentially overbought. The market multiple is back to being stretched. So there is room for disappointment in the market this week. That's kind of the key message. When we take a look around, it kind of speaks for folks to take a look at our Market Hedge model. But again, there's other data coming this week beside the Fed. It will be important, but we'll get take another look at the consumer with August retail sales. Data from Visa and their spending indicators seem to suggest that the consumer rebounded a little bit in August. Our concern is that all of the July digital shopping events from Amazon, Walmart, Target, and others might have pulled forward spending into July from August. Kind of, folks that we've been hearing about that are trading down, looking to stretch their dollars, that they might have leaned into those events for back to school shopping. Kind of, again, pulling that forward from August. So that's one of the reports that we'll get this week, and we'll be eyeing that, especially as it relates to our cash-strapped consumer model. We do get two other key pieces of data this week. One is going to be industrial production, another look at the manufacturing economy. We'll have to sift through that, tease out what's happening with utilities and mining and focusing on core manufacturing. We'll want to do this because it's another look at that part of the economy. And when we got the August PMI data from ISM and S&P Global, it said that part of that economy was contracting. So we want to take another look at that and potentially see what that might mean for GDP expectations. And the other key data point that we're going to get this week will be August housing starts. We, of course, will be paying very close attention to that for our home building and building products model. Now, mortgage rates have started to come down. I think that's kind of helping build some enthusiasm, especially as the Fed enters a rate cutting cycle. The thinking is that, we've seen 30-year mortgages come down into the sixes. As we move into 2025, perhaps we could see those move nicely to lower, depending on the number of rate cuts, perhaps into the fives, and that could re-accelerate the housing market. So we're not looking for anything big, any demonstrative changes in the August data, but we will be parsing it between single family and multifamily. We'll also be taking a look at not just the seasonally adjusted data, but the non-seasonally adjusted data, kind of comparing that over the last few months to see if home building activity has picked up. Generally speaking, just because of the summer weather, we would expect to see more housing starts, kind of some seasonal strength, but if it's stronger than that, that would be a positive signal for our home building and building products model, and that is one that we think will start to perform well as the Fed starts to deliver those rate cuts. But, as I said before, we do think that the Fed has some room to disappoint the market, throw some cold water on its aggressive thoughts for rate cuts. If we do see that market pullback, that's where that market hedge model comes in. But it could be an opportunity to revisit some of these modeled at better prices. So I would say stay tuned. Make sure you catch our thematic signals on Tuesday, where we're going to have a lot more ripped from the headlines, and then Thursday we'll have another set of ripped from the headlines, but our opening comments in that particular alert will dissect what the Fed said and what we think it means. So I'm sure you'll want to tune in for that. But all the way around, folks, have a great week. We'll see you back here before too long.